Hello everyone, welcome to Week 11 learning videos once again. In this learning objective, we discuss the advantages associated with international diversification within a portfolio. There are several advantages of internationally diversifying a portfolio. First of all, when investors diversify internationally, they expand the feasible set of investments across all stocks that exist in each national markets that they are now accessing. We know that across international stock markets, there is going to be the opportunity to invest in stocks that have a wide range of characteristics with respect to risk and return. And it may be that you can actually access risk and return characteristics that aren't possible within your own domestic market. However, the most important reason is the diversification benefits that can be achieved. Cross market correlations are almost always less than one. So because we have got less than perfectly correlated markets, it means that when we internationally diversify, we can achieve benefits by lowering the overall level of risk within our portfolio. It means that the level of risk of an internationally diversified portfolio tend to be lower than that of a domestic diversified portfolio. Another reason is some large firms are often overseas. So if you are an Australian investor, some of the large multinational companies that are not listed in the Australian securities market. So if you just invest as domestically, you wouldn't be able to get access to investing in these stocks. Also, other markets around the world might have different characteristics compared to domestic markets. Take the example of emerging markets. We know that they tend to have higher risk and higher return as compared with developed markets, and that might suit the risk return appetite of a particular investor. Now, to summarize the risk and return characteristics of different markets around the world, we can see this table which provides a summary of the average returns and standard deviation of returns across a range of countries in the decade from 2000 to 2009. Now, what we know about this decade was that it did include the global financial crisis, which is why in some countries, for example, United States, the average monthly excess return is actually negative. So as we look down this list of developed countries, we can see there is a quite a lot of variation across average returns. Interestingly, if you look at Australia, Australia is one of the market that did very well during this period, and that's consistent with the argument that Australia was relatively immune to the global financial crisis, at least relatively compared with other markets. Also, we know that the GFC was followed by a significant rally in the Australian stock market due to the mining boom. We also see significant differences across the standard deviation of returns throughout these markets. Some market, for example, Finland and Korea, you can say have much higher standard deviation of returns, whereas for US market and also if you look at some other markets like Japan, they have a standard deviation of monthly returns that are much lower. Now we see this a similar picture in emerging markets. However, particularly interesting though is the contrasting risk and return characteristics across the developed market with the risk and return characteristics across emerging market. So in this slide, we again can see the average returns and standard deviation of the emerging market for the same 10-year period. What we can see is we are getting substantially a higher average return. If you look at this average return, which is substantially higher compared to that of developed market. Average return is around 2% per month compared with 0.5% for the developed markets. However, the flip side is that standard deviation of returns is also substantially higher. And we also find that the beta of those countries in relation to the US market tends to be above 1 in most of the cases, which means that these markets go very significantly with the US market and have a very large standard deviation of returns, so they are quite risky. But the returns commonly show that there may be some benefit in investing in emerging markets. Now, this graph shows a relative price comparison of the developed markets and emerging market stocks. So you can see here that these blue bars are indicating developed markets and the red bars are indicating emerging market. And these bars basically show the average price earnings ratios for the countries. And if you carefully look at this bars, you can see that the price earnings ratios of the developed markets tend to be higher compared to the average price earning ratios of the emerging markets in the early 2000s. So which indicates that the stocks in the developed markets were relatively overpriced compared to the stocks in emerging market. However, you can see just prior to the global financial crisis, the average P/E ratio in the developed and emerging market tend to be similar. And in the global financial crisis period, once again, the P/E ratio in the developed market went up compared to emerging markets. However, from 2009 to June 2013, you can see although there is still some overpricing observed in the developed markets, as you see that average P/E ratios are higher, but the discrepancy between the average P/E ratios of the developed and emerging markets are substantially lower in these periods compared to the periods in early 2000s, which indicates that the markets are getting more integrated globally across the time, and now their prices tend to be similar. So overall, this result may indicate that although there is some benefit of diversification and some benefit of investing in emerging markets due to the underpricing of their shares, but this underpricing or this diversification benefit is dissipating over the time. This table shows the correlation between the US market and the other markets, particularly the developed markets. And you can see that almost all the correlation coefficient are less than 1, indicating that still there is some diversification benefit investing across globally. For example, you can see in Australia, with Australian market, the correlation coefficient between 1970 to 1989 was 0.47, and between 1991 to 1995 it was 0.36, and the second half of the decade was 0.64, and from 2000 to 2009 it was 0.79. So we can see that still there is some diversification benefit left as we invest globally. However, one interesting point we can look at as we move from right to left, we can see that the correlation coefficient is gradually increasing. For example, you can see 0.33, 0.33, 0.64, and 0.84, which might indicate, as I just mentioned in the previous slide, that although there is an international diversification benefit is still left, but as the markets are becoming more globally integrated and investors are now more tend to invest globally, so diversification benefit is gradually getting lower and lower. And this is an example that how international diversification provides benefit to investors. So this graph shows how the number of a stock reduces the systematic risk. As you can see, in the vertical axis we have percent of risk, and the horizontal axis we have number of risk. And as we increase the number of stocks, as we increase number of stocks in our portfolio, so unsystematic risk continue to decrease, and then this line becomes asymptotic, indicating the level of systematic risk that cannot be reduced by increasing number of stocks. So you can see that for a US portfolio, the level of systematic risk is here. However, as we include global stocks in the same portfolio, the systematic risk decline, and now the level of systematic risk is here. So it indicates that as we include more and more stocks in the portfolio from the global market, it not only reduces unsystematic risk, it also reduces systematic risk as the portfolio gets exposure to different markets. So the systematic risk reduces because it reduces the exposure to one particular market. Now, what we need to think about is how the relationship or the diversification benefit changes over time. If we look at this diagram, it shows the correlation between the US market and the other markets into different periods. You can see the bars, those are the blue bars and the maroon bars. The blue bar shows the correlation between the US market and other markets when US market takes an upturn, and this maroon bar shows the correlation between US market and other markets when the US market is in a crisis. Now, I can see generally that these maroon bars are longer than the blue bars, indicating that the correlation increases when the US market is in crisis. Now, you understand that it's actually a problem. The reason that the diversification benefit is most expected when a market is in crisis. However, we can see that when a market is in crisis, the correlation increases, so markets become more integrated and the diversification reduces. And this is a similar result for the emerging market. The previous slide that we have shown is an example of developed markets. Now this is the case of emerging markets. So once again, this blue bars shows the correlation between the emerging markets and the US markets when the US market is positive, and the maroon bar shows the correlation between US market and the emerging market when the US market is negative, I mean has a downward condition. Now, once again, we can see that in general, these maroon bars are longer, indicating that when US market is in crisis, the correlation increases. Okay, so correlation increases means the markets become more integrated and the diversification benefit reduces. So we can see that although we go for diversification by including global stocks in our portfolio, but we get less diversification benefit when the markets are in crisis. This also can be looked at by a specific event. For example, you can see these two lines are the correlation. This black line is the correlation between the US and the rest of the world, and this red line is the correlation between the US and another global market index. And if you look at this dot-com bubble period, you can see that correlation substantially increases. In general, the correlation between these markets ranges between 0.4 to 0.6. However, during the dot-com crisis, the correlation increases up to as high as 0.8, I mean 80%. So it once again indicates that diversification benefit is reduced when the markets are in crisis. And here, as we can see, a similar evidence during the 1987 stock market crash, and these different lines indicating different markets. For example, North America, Ireland, large cap European stocks, small cap European stocks, Asia, and Australia and New Zealand. And we can see that during the period of crash, not only the US market price declined, the market price of all the countries the global stock price declined. So overall, we can say that although we go for diversification, including global stocks, we can achieve diversification benefit by this practice. However, we need to note that excess return generated by emerging market appear to be dissipating in recent times, indicating increased integration of the market, and the diversification benefit reduces when the markets are in general in crisis. So that's the end of our discussion in this learning objective. Thank you.